Ever wondered how rising loan delinquencies could impact the economy?
Absolutely. Experts like Danielle DiMartino Booth explain these trends and reveal where the economy might be headed.
We've sifted through hours of analysis to bring you only the most crucial insights, saving you time.
Stay tuned. From the Florida housing market to student loan impacts, we cover it all in this jam-packed video.
Today, we're analyzing insights from Danielle DiMartino Booth on the concerning rise in consumer loan delinquencies.
Danielle highlights that delinquencies are increasing across all loan types, indicating potential economic stress.
Danielle notes that the FOMC's increasing mention of the term uncertainty raises alarms.
She argues that rising delinquencies may reflect broader economic concerns.
Based on Danielle's analysis, net job losses began in the second quarter of 2024.
This reality contrasts with consumer perceptions, impacting their spending behavior.
Danielle points out that higher-income individuals are also facing increased delinquencies.
She illustrates how these trends signify a shift in financial stability across income levels.
Danielle discusses the trend where younger millennials hesitate to fully engage in the job market.
This raises important questions about the future workforce and its economic implications.
Danielle predicts ongoing engagement challenges among younger generations in the workforce.
The broader economic impact could be significant if these trends continue.
Danielle concludes that households and policymakers must proactively address these challenges.
She emphasizes the need for practical strategies to enhance financial resilience in this uncertain environment.
Today, we're delving into Nick's analysis of the Florida housing market, which showcases troubling trends as prices continue to decline.
Nick emphasizes that despite builders continuing to construct new homes, the underlying market fundamentals indicate a significant downturn.
Nick points out that home builders are still active, even as data shows home prices are collapsing.
He warns that if these trends continue, Florida could face a situation reminiscent of the 2008 housing crisis.
Nick observes that home values are down 3.5% statewide, with even steeper drops in areas like Manatee County.
He highlights the critical situation where builders are increasing supply just as prices continue to fall.
Nick reveals that inbound migration to Florida has decreased by a staggering 80%.
This substantial decline puts additional pressure on home prices as supply outstrips demand.
Nick examples a homeowner who bought at $315,000, now facing a sale price of just $265,000.
This illustrates the harsh reality for sellers in today's Florida housing market.
According to Nick, we can expect a price decline of about 5.5% in Florida's housing market.
Some regions could see even steeper drops, potentially reaching 8 to 10% over the next year.
Nick concludes that buyers should closely monitor overvaluation rates in their areas.
Understanding these trends is essential as we anticipate market corrections in the months ahead.
Welcome. Today we're discussing the analysis from David Lin about South Korea's central bank's decision to cut interest rates.
David emphasizes that the Bank of Korea's actions reflect broader global economic trends influencing monetary policy.
According to David Lin, the Bank of Korea's latest cuts illustrate a significant response to worsening economic conditions.
David highlights that initial inflationary fears related to trade issues have given way to concerns about a weakening economy.
David Lin states that central banks, including South Korea's, initially anticipated inflation from trade wars.
However, as David clarifies, the focus has shifted to the worsening economic conditions. David mentions that the Bank of Korea has lowered rates to 2.5%, nearing historically low levels.
With ongoing economic difficulties, expect more cuts, according to David's insights. David notes that South Korea's economic struggles are part of a broader global trend.
He points out that various countries are revising economic forecasts and implementing similar monetary policies.
With the latest forecasts, what does David anticipate in the coming months?
David foresees a significant likelihood of recession as global economic weaknesses become apparent.
David concludes that proactive monetary policies are crucial for addressing these economic issues.
He underscores the need for investors and policymakers to remain vigilant and responsive to changing economic conditions.
Today, we're examining Mark Thompson's critical views on the 401k retirement plans.
Mark highlights key concerns about these plans that jeopardize long-term financial health.
Mark emphasizes that typical 401k plans can lead to insufficient retirement funds.
He notes that high fees can severely diminish investors' returns over time, threatening financial security. Mark explains how inflation can significantly impact retirees' fixed incomes.
With rising costs, maintaining a lifestyle becomes a challenge for many retirees.
Right. Relying solely on fixed retirement accounts poses real difficulties.
Mark encourages investing in real estate to mitigate against inflation.
He argues that tangible properties offer more stability than conventional retirement accounts.
Mark stresses the importance of diverse planning for retirement.
He insists that improving financial literacy is essential for better investment decisions.
What insights does Mark have about future planning for retirement?
Mark anticipates a shift towards alternative investment strategies as conventional methods face increasing pressure.
Mark suggests that viewers explore real estate as a key aspect of their retirement planning.
Moreover, it's crucial for individuals to remain aware of various financial options they can leverage.
Welcome back to Kitco News, where today we delve into Adam Rozencwajg's insights on what the future holds for commodities as we approach 2030.
Adam argues that we are on the verge of a major structural move in the commodity market, facing new opportunities amid shifting economic landscapes.
According to Adam Rozencwajg, the commodities markets often cycle in long phases, and we are now seeing signs of the current bearish phase ending.
He emphasizes that, as commodities look undervalued compared to stocks, the environment is ripe for a new bull market.
Adam notes that with a lack of reinvestment in the supply base for commodities, tighter markets are anticipated in the near future.
He suggests that energy and uranium will particularly see notable price movements due to these supply constraints. Adam discusses recent legal challenges, including a ruling against Trump's tariffs, which could impact inflation and commodity pricing.
He urges investors to remain vigilant as these factors introduce volatility into the market. What does Adam predict for the commodities market outlook toward the year 2030?
Adam forecasts considerable upward movement in commodities and emphasizes that equities will likely provide better investment results.
Adam concludes that savvy investors should prioritize equities for better exposure to growing commodity values.
He highlights the need for portfolio diversity, particularly towards sectors poised for growth in the coming years.
Today we discuss insights from Stephanie Pomboy regarding the impact of student loan repayments on consumer credit.
Stephanie notes significant stress among student loan borrowers, which may lead to broader credit issues.
Stephanie points out that restarting student loan payments has resulted in rising delinquency rates among borrowers.
This suggests borrowers may prioritize student loans over other financial obligations. Stephanie highlights that as consumers prioritize student loan repayments, we may witness a decrease in their spending capacity.
This shift could intensify existing economic pressures. Stephanie indicates that rising corporate debts are concerning due to consumer financial vulnerability.
Concerns over corporate credit health escalate with rising interest rates and consumer stress.
Stephanie warns that escalating delinquencies could lead to a crisis resembling past financial turmoils.
This would fundamentally hinder the economy as consumer spending wanes, causing further complications.
Stephanie advises consumers to revisit their budgets due to increasing loan payments and financial uncertainties.
Banks need to be vigilant, understanding the changing landscape in consumer credit and potential defaults.
Wow, we've covered a lot of ground today with our financial experts.
Indeed, we have. Each guest brought such a unique take on the challenges we face economically.
For instance, Stephanie Pomboy really highlighted the urgency of the rising stress in consumer credit, especially for student loan borrowers.
And Adam Rozencwajg discussed the structural changes in the commodity market due to supply constraints, which is a critical angle that complements Pomboy's insights.
Totally. It's interesting how they agree that inflation impacts both consumer behavior and investment strategies.
Yes, but as we saw, Pomboy and Rozencwajg have different timelines for when these pressures will materialize.
Mark Thompson was particularly critical of the 401k system, which adds a different layer to the conversation around financial stability.
And David Lin provided an important perspective on South Korea's economic strategies amidst global pressures. It's a tough balancing act.
Then we had Nick with his take on the Florida housing market, which is facing a strange paradox of construction versus declining prices.
And let's not forget Danielle DiMartino Booth, who brought attention to the implications of rising delinquencies and changes in consumer spending.
These discussions show how interconnected these issues are, really adding depth to our understanding.
Absolutely. If you found these insights valuable, make sure to like this video and subscribe for more expert analysis.
Your support means a lot to us and helps bring more discussions like this to your screens.
And don't forget to check out our upcoming video on global trade dynamics next. You won't want to miss it.